Hi everyone, this is Alex from MyTradersJournal.com. Today I'm covering what is a stock option. This is just a brief overview for those who are new to investing with options. Before we get going, here's some side notes worth mentioning. For simplicity, I'll only refer to stock options for the rest of this video, but the same principles hold true for ETFs that trade options in every case. I'll always be referring to American options on this channel unless I specifically state otherwise. I'll be referring to traders as he in this video, but I recognize some of the best traders out there are women, and I simply went for brevity. Go easy on me. Now on to the good stuff. Stock options are usually referred to by the type of option, either a put option or a call option, and are essentially insurance contracts for a stock in their most basic function. An option represents 100 shares of the underlying stock per contract. Every contract has an expiration date and a strike price. The expiration date is the third Friday of the month for standard options. Weekly options are available on a lot of stocks, but for a beginner, I suggest only focusing on the third Friday. The strike price is the price where an option contract can be assigned or exercised, and the price paid for the contract is called the premium and varies depending on duration of the contract, how far away the strike price is, how volatile the stock is, and if dividends are due before expiration. That's just to name a few of the major input factors. Traders can buy insurance to protect downside risk through puts and can buy protection from upside risk with calls. As I mentioned before, you can be the insurance seller too. These trades are contracts between a buyer and a seller, also known as a writer, as in a writer of a contract. The buyer has a choice or an option, clever huh, to execute the contract when he or she wants to and can assign shares to the seller without waiting for the other trader's acceptance. The seller has the option to buy the contract to close the position if he can do it before it's assigned, but he has to find a seller to do so. And if the option is moving quickly against him, this can get very expensive quickly. So, why trade options? It really just depends on the trader's outlook and motivation. Here are a few examples. A trader who owns a stock and doesn't want to sell it but wants protection from a correction can buy a put and limit his losses if the stock drops. If he doesn't exercise the put, he loses 100% of the premium, just like we don't get anything back for the car insurance we pay each month when we don't have a claim. A trader can buy a put without owning the stock if he expects the price to drop. This is considered a synthetic short position since he'll profit as the stock falls, but his risk is limited to the premium paid. A trader who wants to buy a stock but thinks it'll dip before pushing higher can write, remember selling and writing are synonymous, write a put to be paid to wait for the dip. If the stock drops below the strike before expiration, the buyer might assign the shares to him. Most brokers automatically assign at expiration, so check with your broker if you aren't sure. If the stock doesn't fall below the strike, the put writer still keeps the premium received, but doesn't get down the stock. It's like a limit order that pays the writer to wait, except the contract doesn't guarantee he'll get to buy the stock if the price drops and rebounds before expiration. The difference with a limit order is that the trade will trigger as soon as the stock hits the limit price. But if it doesn't fall that far, the trader who used the limit order has nothing to show for his patience, like the put writer would from the premium. A trader who wants upside gains from a stock but doesn't want to pay full price for the stock can buy calls and use the option's leverage to profit if the stock price increases. A call buyer's risk is limited to the premiums paid and doesn't profit until his gains outpace the premiums paid. If the stock doesn't rise above the strike, the call buyer will lose 100% of the premiums paid. A trader who thinks a stock has limited upside can write calls. If he owns the underlying stock and it trades above the strike at expiration, he'll be forced to sell his shares, but gets to keep the premium received. An aggressive trader might write calls without owning the stock based on the belief the stock will fall or at least not rise above the strike before expiration. A writer's profit is limited to the premiums received, but his losses are unlimited as the stock price continues to push higher. Understanding the nuances of what causes premiums to change requires a lot more study and experience you can get from a short video. If you're new to trading options, don't be in a rush. Making mistakes with options can be a very expensive education. As I said at the beginning, this is only meant to be a brief overview of investing with options. I'll have other beginner videos posted before long, and we'll begin to upload my real trade summaries soon to help viewers learn from my experience. My option trades from previous years are still posted on my blog at mytradersjournal.com/stock-options. If you want to look back at my option trading history since 2007, it's all there. If you don't want to read it online, my book that includes all of my 2012 trades is on Amazon. Search for My Trader's Journal 2012 to find the paperback and Kindle versions. Of course, I have to have a disclaimer. This is not personal investment advice. Trade at your own risk. And now the obligatory call to action. Please subscribe below to be notified of updates. There. Thanks for watching. See y'all soon.